Welcome, Dan, to the Building and Growing podcast. We're very grateful to have you here today.
Thank you. A pleasure to be here. Always good to chew the fat with you, Lucas.
Excellent. Thanks so much. Dan joins us from Integrated Finance, is one of the co-founders there. Do you want to start off by giving us a bit of an intro to yourself and to the company?
Sure. So I'm Daniel Cronin. I'm a co-founder and COO slash CCO, or if we were in Silicon Valley, it would be CRO of Integrated Finance. Generally, I oversee all operative and commercial aspects of the business. What does Integrated Finance do? We are a software as a service build and management platform for fintechs looking to launch fintech products. You can kind of look at us as a core bank for young fintechs. Mm-hmm. We have a focus on getting fintechs connected to multiple banking as a service platforms and fintech friendly banks, whereas some of the maybe larger players in the industry like Mambu, they would typically focus on much larger integrations to either the schemes themselves or to tier one banks operating in multiple territories.
Okay, excellent. So you're helping support younger fintechs to connect to different financial service providers. Do you mind telling us a bit about what the journey would have been for a fintech prior to Integrated Finance launching, and what problems you're solving through the product?
Sure. Well, I suppose I can tell you a little bit about myself and the founders of Integrated Finance's background, because it's really our own problem that we were trying to solve. It was our own itch that we were trying to scratch, as it were.
Yeah.
So we're second-time founders in the fintech space. The first time we went and got a license with the UK regulator, the FCA, to offer a financial service to small to medium enterprises. As a young fintech, we struggled to entice any tier one bank to work with us. And because we couldn't get a tier one bank to work with us, what that meant is we had to kind of do a patchwork knitting of tier two banks and other fintech friendly services together in order to make it look and feel like our customers were just interacting with one financial entity. The problem we had when doing that is in say the 90s and the 2000s, you could partner with a tier one like Barclays and get access to fantastic Great British Pound payment infrastructure.
Yes.
Fantastic single European payment area infrastructure, SEPA, Instant, you name it.
Yes.
You could get access to US dollars, either via SWIFT or on the local market on, say, Fed or ACH.
Yes.
And they had built correspondent relationships with most of the tier one players in each jurisdiction. And so if you partnered with Barclays, you could effectively give all of Barclays services to your own customers, and then you would improve upon that service by targeting a particular vertical or sector of the market. Maybe they were getting weak exchange rates because they didn't have the volume to get a good exchange rate directly from the bank. Okay. Maybe it was a lending solution. Maybe it was international payments. You name it, it doesn't really matter. As a young fintech, no bank wanted to touch us. We just presented too much risk and not enough reward for them.
Yes.
And so what we ended up doing was going to the, and I mean this with no disrespect, banks that had very little international footprint, but they had a very compelling offering in their own jurisdiction. So we partnered with the likes of Clearbank in the United Kingdom and got a fantastic sterling offering. We partnered with a bank that powered a lot of fintechs a few years ago. They no longer serve fintech now. That was Deutsche Handelsbank.
Okay.
We got access to euro clearing. We ended up working with another bank in the United States to give them local access to the dollar market. And it was really a stitching together of all of these solutions to give our consumers a a banking service that could compete against the tier one players in the market.
Mm-hmm.
But it was extremely difficult. The problem was with all of these integrations to different banks, our integrations started taking longer and longer to develop, execute, and deliver, because more and more of the logic of that bank was being accommodated into the back end that we'd built.
Yeah.
So we'd built a hodgepodge solution of banks that were willing to support fintechs, precisely because we posed no risk to burning their correspondent banking relationship network. So either the fintech didn't operate overseas, the bank didn't operate overseas, so it had no dependency on a foreign currency to run its typical operations.
Yes.
Or it had no correspondent banking relationships at all. So there was no exposure that the fintech brought to damage to that bank's own revenue stream. Part of the problems with the likes of Barclays, Deutsche Bank, JP Morgan is they've got very large correspondent banking relationships.
Yes.
And you need those correspondent banking relationships to be able to establish global operations.
Mm-hmm.
If you don't have global operations, you'll never be able to entice in the blue chips, the multinationals, the megacorps.
Yes.
Apple isn't going to bank with Barclays in London if it doesn't have access to dollars.
Yes.
Apple will want the suite of currencies they need to operate worldwide with every bank in the world.
Mm-hmm.
And part of the problem of fintech poses that bank is they effectively delegate risk. If a bank says, I will work with you, say Revolut or TransferWise, what they're really saying is, I trust you to use my payment rails in a responsible way.
Yes.
And the likes of Revolut and TransferWise are sufficiently staffed up, resourced, and have the technological capacity to spot things like money laundering, fraud very quickly, whereas some of the younger fintechs in the space maybe don't have either the expertise or the capital to expend on non-revenue generating activities such as that.
Okay.
So the risk for Barclays or Deutsche Bank to let a young fintech on their rails
Yes.
is too high, because if that fintech makes one small mistake, there's a very high chance that Barclays will have a correspondent, let's say JP Morgan or whoever their dollar clearer is. They're saying,
Yes.
you've exposed our network to money laundering. We're going to turn off your access to US dollars.
Okay.
If you turn off Barclays' access to US dollars, you can kiss goodbye, any NASDAQ, Fortune 500, FTSE 100, all of the big companies that currently depend on someone like Barclays to operate their global operations.
Yes.
That would be kaput. And the 80-20 rule, banks will make 80% of their revenue from 20% of their clients. They don't want to put that 20% of their clients at risk for the sake of a young, untested fintech.
Yeah.
And back to the point I was getting at, that's what we were. We were a young, untested fintech. So we had to partner with banks who had no exposure to correspondent risk and were willing to take a punt on an increase in volume going through their network, so they had larger deposits to be able to lend against.
Yes.
By working with fintechs that had the capacity to attract a higher number of customers, whether that be B2C or B2B.
Fantastic.
So just to tie that one off, having built all of these integrations probably quite poorly, by the end, we realized that there was this new layer of fintech-friendly banking options called banking as a service.
Yes.
It's where a more established vendor like a Currency Cloud or a Rails bank in the States, you're getting, say, Unit, Bond, companies that had poured more energy into ensuring that all of the sorts of things that a bank doesn't want to facilitate, such as potentially fraud, money laundering, non-compliance on client money regulations, all of that sort of stuff. These banking as a service players were slowly abstracting that problem from the bank to themselves, and they had the capacity to support younger fintechs without exposing the bank to the same level of risk.
Yes.
And we realized as founders of this fintech, that there was nobody trying to abstract the differences between all of these banking as a service APIs, so that we could give one compelling either interface or technical gateway for these fintechs to be able to access this plethora of new technology. And ultimately, why did we start integrated finance? It was to solve the problem that we had when trying to integrate all of these BaaS players, just to get to market with either an MVP or a slightly more fleshed out product.
Fantastic. So we covered a lot just then, and I think it's really important just to sort of compartmentalize it to ensure that we can break it down in a simple manner. I'm thinking, for example, if my parents are listening to the podcast, I want them to be able to understand. So the narrative was there were a lot of smaller fintechs, such as the previous company that you founded, out in the market. Barclays and other large incumbents may have offered a very wide range of services when it comes to making bank transfers or holding foreign currencies. However, the risk for them to onboard smaller fintechs was too high, and the smaller fintechs also had quite a large, let's say, integration burden on them. And so what you guys did was build integrations to smaller banks, and then you realized, actually, if we build one, let's say, API or interface, we could connect to all of these smaller banks, as well as some of the banking as a service providers like Currency Cloud and others, to provide not just, let's say, the payment rails, but also the compliance and regulatory aspects. So KYC, anti-money laundering, and other regulatory requirements would be fulfilled. So in terms of the benefits, you've got the fintech reduces its integration time for multiple providers. They also are assisted, let's say, with the regulatory and compliance pieces. The larger banks, or any bank involved, knows that there's a particular quality standard that they're going to receive from any clients flowing through, let's say, integrated finance. So their, let's say, counterparties, know that things are going to be done in a compliant manner. You really benefit because you're able to open up a new part of the market. So although I wanted that to be a concise sort of summary, it ended up being a bit longer than I wanted. But would you agree with that?
Sure. So I guess the way to unpack it is, what is the benefit for the consumer of the product? We built this thing for ourselves badly in a previous life. The venture was successful and we exited somewhat successfully. But really all we were trying to do was solve our own problem, which is how can we take our product live faster without investing time in stuff that our customer doesn't care about.
Yes.
We were losing sleep over how to ensure that the accounts that we generated for our customers were going to be in our customer's name, so that when Sofa Limited was a made-up company. I'm just pointing out what's in front of me in the studio. When Sofa Limited wanted to pay their invoice to a textile manufacturer in, I don't know, Ireland or Turkey, textile manufacturer received the payment from Sofa Limited. Instead of them receiving it from payments broker or PSP1 or Transfer X or whatever the name of the fintech supporting that transaction is. We would lose sleep over how can we onboard Sofa Limited in a smooth and easy way that's not going to dissuade the financial controller or the FD or the CEO or the accounts payable clerk from completing this onboarding journey that is quite intensive. We lost sleep over how do we give these guys fantastic exchange rates And what we realized is our customer didn't care about the why. Our customer didn't care about the how. They cared about the output. They cared about the thing that they had touch points on. And what does a customer have touch points on? It's an interface. So
Yes.
we were pouring all of our energy into table stake stuff that didn't make us any different from a Barclays, that didn't make us any different from a Revolut, didn't make us any different from a Chime or a Wise or a Starling Bank. We were
Yes.
pouring all of our energy into just being able to do the same things as them. And by the end of it, we didn't really have a lot of capital, willpower, or engineering resource to go and create to create the compelling reason for the customer to use what we'd built instead of what our competitors were building. And so boiling it down, all integrated finance is trying to do is to divert your attention, resource, and capital to where it matters.
Yes.
If you're starting a financial service, presumably there's a problem you've seen in the market that needs to be solved. But if you expend all of your energy on just being compliant, regulatory, being compliant commercially, protecting your client assets in the way that you're supposed to, converting currency in the way that you're supposed to, assigning a name to a bank account in the way that you're supposed to, you're going to have unless you're super funded, unless it was Adam Neumann starting a fintech today.
Yes.
Unless you're hyper funded, you're going to invest all of your energy on something that isn't going to make you win your customer. And there's a fundamental problem with that equation. If you're spending money on extremely important stuff, being compliant, protecting your customers, you're not going to win customers. You need to be different from what's out there in the market. And presumably, an entrepreneur doesn't wake up in the morning and go, "Oh, I'm going to start a payments company." Well, what's that payment company going to do? What problem is it going to solve?
Yes.
I didn't think about that. That's not how entrepreneurs work. They're usually worrying about the bleeding edge problem that's going to make a difference in this world. But having tried to start a revolutionary fintech, what I understand is your resource quickly dries up on the stuff that customers don't care about.
Okay.
We're trying to solve that problem fundamentally.
Okay.